so October, November 2017 paper. Question 1, calculate the equilibrium level of output and income if you get the following variables. In the goods market model, show the formula and all calculations. All right, pretty standard. You are definitely going to get this calculation in your exam. You should remember it from 1501, 1601. Firstly, what you need to do is you need to calculate your multiplier, and to do that you use your MPC, marginal propensity to consume. Your formula for your multiplier is 1 over 1 minus C. So in this case, 1 over 1 minus 0.5, 1 over 0.5, 2. Should get an answer of 2 for your multiplier. All right, then to calculate your equilibrium level of income, the formula is y is equal to the multiplier times all your autonomous variables. All right. All right, so to fill in your variables, we calculated your multiplier as 2, your autonomous variables, autonomous consumption, C0, 300 plus investment plus government expenditure. Now, when you're dealing with tax, okay, remember we said that tax that you pay was endogenous, right? You don't pay tax unless you earn income. You don't pay tax unless you buy goods and services. So tax depends on your marginal propensity to consume. Obviously, it's a negative, so you subtract it, but you have to first multiply it by the 0.5. All right. So it would be 2 times 300 plus 400, and 300 would give us 1,000 minus 0.5 times 100, which is 50. 2 times 950 gives us 1900. Then in question 2, calculate what will happen to the equilibrium level of output and income if a contractionary fiscal policy is introduced where government spending decreases to 200 and taxes increase to 150. All right, so I actually calculated this the wrong way the first time. It says, yeah, government expenditure decreases to 200, but they don't always word it like that. They say sometimes it decreases by 200, which would obviously give you different results. Okay, so just read that carefully in your exam. Now, there's 2 ways that you could have actually done this. The first way is if you just replace all of your variables and solve for your equilibrium level of income again using these new values for tax and government expenditure. So if you did it that way, equilibrium income would have equaled 2 times 300 for your autonomous consumption plus 400 for your investment plus now 200 for your government expenditure minus 0.5 for your MPC multiplied by the 150 for tax. Okay? And if you solved all of that, $1,650. They're not asking you to calculate it, they're asking you what happened to it. So then you need to obviously subtract that from your original and your equilibrium income changed or rather decreased by 250 when government ran a restrictive fiscal policy. Right. Everybody cool with that? Now, I said that there was another way that we could have done this. Actually, no, just remember this way. So, well, you could just say maybe at the bottom there that, yeah, equilibrium level of income decreased by 250 when government ran their restrictive fiscal policy. Nothing more than that. Use the data in the questions above to illustrate with the aid of a diagram the impact of the contractionary fiscal policy on the equilibrium level of output and income. So remember, when you draw your goods market, you always got to put in your 45-degree line. A is equal to Y. So that was our original. Now, in our original calculation, we calculated it as 1900. When government runs a restrictive fiscal policy, there is a decrease in government expenditure. What do we do when we have a decrease or increase in an autonomous variable? We either shift the curve up or down. So in this case, a decrease in government expenditure, we're going to shift the curve downwards. All right? And you know that because you calculated your second equilibrium level of income as 1650, which is obviously less than 19. Doesn't really matter what you call the curves, as long as you show which way they are shifting. So I'll just call it A1 and A2, autonomous variables 1, autonomous variables 2, or A1 and A2 for aggregate demand. It really doesn't matter. All right. So then it's a decrease in government expenditure, or it is an increase in taxation. All right. Now, if they had, on the other hand, told you that tax rate changes, you would have pivoted the curve. Okay. But they gave you a capital T, so you shift the curve. All right. And we calculated our new equilibrium level of income as 1650. All right. Everybody all right with that? So you've got to label your curves and you've got to draw in the arrows to show which way everything is moving. Explain briefly the impact on the budget deficit after the implementation of contractionary fiscal policy. Show the formula and all calculations before and after the implementation of the policy. All right, so now when you are running a budget deficit, okay, now budget deficit is obviously when government expenditure is greater than taxation, okay? So how will it affect your budget deficit when they run restrictive fiscal policy? It will decrease your budget deficit, okay? So there will be a reduction in the budget deficit. All right. Budget deficit is obviously when your government expenditure is greater than your taxation. However, in a restrictive fiscal policy, government is decreasing government expenditure and or increasing taxation. All right. So before the introduction of the restrictive fiscal policy, we had a government expenditure of 300, obviously greater than our taxation of 100. And after, our government expenditure was reduced to 200. and taxes were 150. Now, what you've got to do is you've got to substitute these into your formula. All right, so to calculate your... All right, so obviously the difference between those two, in the first case, if we subtract taxation from our government expenditure, we're going to have negative 200, a budget deficit of 200. All right, remember, taxation for the government is a plus because they're earning taxation, and spending is a negative. All right, so it's tax minus government expenditure. And in the next case, 150 minus 200, we got a negative 50. So when they run restrictive fiscal policy, it does not necessarily mean that they will move into a budget surplus. It just means that there is a reduction in the budget deficit, which is what has happened here. Okay. Explain in words and by using a chain of events how the central bank can use expansionary monetary policy in the financial market to reduce the interest rate in the economy. Explain what will happen in the financial market and the bonds market. No diagram is needed. All right, they always give you a lot more space than you need here, so you'll see my answers don't cover much of the open space that they give you, but it is enough. Okay, it will get you the marks. All right, so your chain of events in your financial market, okay? When they run an expansionary or restrictive monetary policy, the variables are always the same. It's just the arrows that move in the opposite direction. So in this case, they're telling us expansionary monetary policy, which means that the money supply increases. Okay, so in the monetary policy, money supply increases, which means that real money increases and interest rate decreases. All right, so what is happening here? All right, money supply increases, money is injected into the economy. The demand for bonds increases. As the demand for bonds increases, the price of bonds increase. And remember the inverse relationship between the price of bonds and the interest rate decreases. Right. All right, question 3. Explain in words and by using a chain of events the impact of a depreciation on the real exchange rate by referring to the Marshall-Lerner condition and the effect that it has on net exports and the trade balance. No diagram is needed. All right. So basically, to sum it up here, a depreciation has both a positive and negative effect on our economy. Okay? So when the rand depreciates, okay, now NX is your net exports. Depreciation has a positive and negative effect on your trade balance. How it works. All right. The positive effect is that obviously as the rand depreciates, the price of our exports decreases, not in rand terms, but in foreign currency terms, because they're swapping less foreign currency for the same amount of rands to buy the same product. Okay. So it doesn't affect the rand price, but the price of our exports decreases, which means that exports will increase. Okay? What does it do to the price of our imports? Price of imports increases. Not in the foreign currency terms, but in rand terms, the price increases. Right? Which obviously means that imports will decrease. And therefore, your net exports, your trade balance will improve. All right, but remember when we looked at imports, we actually broke imports up into two different parts. We said that there were autonomous imports and there were induced imports. Now, autonomous imports are imports regardless of your income. There's certain imports that we have to bring into the country in order to produce goods and services. Okay, so capital equipment, we have to bring it into the country in order to produce certain goods and services that are a necessity for us. So whether the price changes or not, we need to bring this in. So that is the negative effect. The negative effect is that even though the price of imports increases, all right, autonomous imports don't change. Therefore, the import bill increases. So the amount of money that we pay for those autonomous imports is increasing in rand terms. All right, now, for the Marshall-Lerner condition to hold, right, real depreciation must eventually lead to an increase in net exports. For this to occur, the positive effect needs to be greater than the negative effect. Okay, question 4. Comparing the impact of an expansionary fiscal and monetary policy in the ISLM, the following results are obtained. Okay. Explain why each of the 5 variables will increase or decrease as indicated in the above table. You must explain the reason for the change in all 5 variables for both fiscal and monetary policies. All right, so I'm just going to use chain of events. It would be good enough for this. And you need to just understand all of these chain of events, but they're all pretty much straightforward and you can learn them straight out of your notes. Okay? So firstly, your expansionary fiscal policy no worries. Now what you need to remember is that your expansionary fiscal policy would shift your RS curve right to the right. And your expansionary monetary policy would shift your LM curve to the right. Okay. And obviously what you're going to have to do is explain the impact on output and income and interest rates. Okay. There's many other variables within the graph, but I'm just saying you need to know how to draw all of these so you know exactly which one they are talking about in these questions. Okay. So, When we run an expansionary fiscal policy, the level of output and income increases, which we could see when we shifted the IS curve to the right. Our new output and income would have been at Y1. Okay? So, for your fiscal policy, number one, yes, output and income is greater. Why? Think of your goods market model. When you run an expansionary fiscal policy, what happens in your goods market model? As we saw in the question one, government expenditure increases, which would increase the demand for goods and services. We would shift the demand curve upwards, and that would increase your equilibrium output and income. Okay, so go to think back to your goods market model. Remember, we derive the IS curve from our goods market model. We derive the LM from the money market. Okay, financial market. Number two, the interest rate increases. Okay, so remember, the ISLM model is the link between the money market and the goods market. And what was the linking variable? Investment. Investment appeared in both your goods market and in your financial market. All right, so now, number two, when income increases, what happens in our money market? Income increases, we shift the money demand curve to the right. Money demand increases. And if you think about your financial market, when you shifted the money curve to the right, the money demand curve to the right, there was an increase in your interest rates. Right, you have to know all the fundamentals, you have to know all the beginning chapters, because all of these chapters, especially in this module, build on to the next one. All right, so if you're lost in your goods market, it's going to hurt you in the exam. All right, you need to understand the goods market, financial market, and then obviously when you put them all together. Right. Number three, a capital inflow on the financial account of the balance of payments. Okay. So now you've got to think when we opened our markets to international trade. All right, openness in the goods and financial markets chapter. We said that when interest in South Africa increased, if interest increased, there was a capital inflow. Why? Because suddenly the return in South Africa relative to the rest of the world was increasing. All right, so then we switch investment from other parts of the world with a lower interest rate towards South Africa with a higher interest rate. Okay. And again, in ecos, you forget everything else. So it doesn't matter what the political situation is. We just think return higher here. In South Africa, we're going to move money here. All right. Number four, exchange rate appreciates. So when the interest rate increases and there is a capital inflow, what happens to the demand for rand? On the international exchange, foreign investors are selling their foreign currency on the international exchange and they are buying rands. Okay? So in the foreign exchange market for rands, okay, the demand for rands is increasing, drives up the price of rands. And what is the price of rands? It is the exchange rate. The exchange rate will appreciate. Number five, trade deficit will increase. So, when you've got a government expenditure increase, exchange rate appreciates. When the rand appreciates, exports become more expensive for foreigners. Imports become cheaper for South Africans. Your trade balance deteriorates. Okay, now for your expansionary monetary policy, we would have shifted the LM curve to the right. Now, the level of output and income increases. So number one, level of output and income increases. Why? Your money supply increases. Real money increases, decreases your interest rates. That's in your financial markets. Okay. Now, remember the link between the financial and the goods market? Investments. When interest rate decreases, what happens to investment? Investment increases. How does that affect our goods market model? We shift the demand for goods curve upwards. What does that do? What does that do to our output and income? We shift it upwards. Sorry, not shift it upwards, we increase it. All right. Number two says the interest rate decreases. All right, so you can see that obviously from your chain of events above. Like we said, that is your financial market chain of events. Number 3, capital outflow occurs. Why? Because our interest rate decreases, our return is decreasing relative to the rest of the world, so it causes a capital outflow. Number 4, our nominal exchange rate depreciates for the exact reason. Capital outflow, what are we doing? We are driving up the demand for foreign currencies on the foreign exchange. As we sell rands, we are buying dollars or buying pounds or buying something else. We're driving up the demand for those currencies and driving up the supply of rands on the international exchange. In currencies, like any other commodity, when the demand increases, the price increases. And in our case, obviously, that means that the rand depreciates, because the price of those currencies, the foreign currencies, is increasing. Price is increasing, which means that they are appreciating. Number 5, trade deficit decreases. We've got an interest rate decrease, which means that our nominal exchange rate is depreciating, which means that exports become more expensive, imports become cheaper. Sorry, other way around. Exports become cheaper, imports become more expensive, and therefore trade balance improves. All right. Right, question 5. Explain briefly why workers cannot obtain a higher real wage through an increase in nominal wages in our labor market model. Identify and briefly explain 2 ways in which labor can obtain a higher real wage. All right, so firstly, real wage is calculated as follows. Real wage is equal to nominal wage divided by price. Okay? Remember, when you divide any variable by price, you are converting it from the nominal to the real. Okay? And prices are determined by firms. Workers can only bargain for nominal wages or targeted nominal wages and therefore not the real wage they are eventually paid. So how can workers increase their real wage? Okay, so 2 things. Real wage will increase if, number 1, markup by firms decreases. If the markup by firms decreases, that means prices are decreasing, therefore real wages increasing. Number 2, if the productivity of labor increases. If productivity of labor increases, there's more goods produced per worker, and therefore more goods for firms and workers. All right. Makes sense. Now, your ADAS question, question 6, always ask you ADAS, and the change that they ask you always comes down to either a contractionary fiscal, expansionary fiscal, contractionary monetary, expansionary monetary. Okay, whatever way that they ask you, it can only be one of those 4 effects. Okay, then they're going to ask you either the medium or the short run. Okay, now your short run is only when there is a movement in your AD curve. Okay, if they ask you for the medium run, then there will be a movement in your AS curve. And obviously you can see in this case that there is a movement in your AS curve, so you know that they are talking about the long run or the medium run. And you need to remember that we always return the economy to the natural rate of output and income, okay, to the YN level. All right. So in this case, they're talking about a contractionary monetary policy, and you can see that obviously because we've shifted the AD curve to the left. All right. Now remember, fiscal and monetary policies are demand management policies. They only ever affect the demand curve or the aggregate demand curve. The aggregate supply curve is your labor market, and that reacts to the change in your demand curve. Okay. So assume the shift from AD to AD1, contractionary monetary policy. In the ADAS graph, use an events chain or words to explain the impact on the level of output and income in the short run and medium run by referring to the events in the financial, goods, and labor markets. Always follows the same process. Okay. So they've told you it is a contractionary monetary policy, so you know you're going to start in your money market first, or your financial market. Okay, so in the short run, starting in the money market first, what is our chain of events in the financial market? Contractionary monetary policy, decrease in money supply, decreases real money, increases the interest rate. How does a change in the interest rate affect our goods market? Through the variable that links the two together, which is investment. Okay? So in your goods market, given your increase in interest rates, there is a decrease in investment spending. Now think of the movement in your goods market. We would shift the demand for goods curve downwards. All right? What would that do to your demand for goods and services? Obviously decrease it. What would that do to your output and income? Remember, demand determines supply. Supply always reacts to demand. So if Z, demand, is decreasing, it means that Y, supply, is also going to decrease. Okay. And that would be the shift of the AD curve to the left. And that would indicate why there is a decrease in output and income. Okay? Now, we still have to explain why prices change. But for us to explain why prices change, we need to go to the labor markets. Okay? So in the labor market, because output and income is decreasing, when we produce less goods and services, it means that we need to employ less people. So employment is decreasing, unemployment is increasing. Now remember, when we looked at our labor market in Unit 8, we said that unemployment and the other variables would affect the bargaining power of workers. Okay? So if unemployment is increasing, it means that the bargaining power of workers is decreasing, which means that they can bargain for lower nominal wages. And also in our Unit 8, how did we determine the prices of goods and services? The cost of labor, wages, plus a markup, whatever it was, would determine the price of products. So if wages are decreasing, it means that prices are decreasing. And now we've explained why prices have decreased. Okay, so we've only explained the shift in the AD curve. The AD curve is the short run. If they ask you medium to long run, that is the reaction of the AS curve to the shift of the AD curve. All right, now, for the long run, and you work your way backwards. So for the long run, you start with the labor market. In the labor market, because prices have decreased, workers revise their price expectations. Okay? So they assume price expectations decrease. Like we said, this is more of a theoretical concept. Because they think prices have decreased, they will bargain for lower nominal wages. And we said that prices are a self-fulfilling prophecy. If we expect prices to decrease and bargain for lower nominal wages, remember, prices are just a markup over wages. So if wages are decreasing, actual prices are decreasing. And we've suddenly explained why price decreases again. All right. Because your cost of labor is decreasing, your cost of production is decreasing, suppliers are going to increase supply. Aggregate supply curve shifts to the right. And then the last step is your combination of your goods and financial markets. So you don't actually do them separately, you just do them as one chain of events. Because you start with your prices, you go straight into your money market first. Okay? So in your financial and goods market, what does a decrease in price affect? Remember, in our money market, we've got real money. So if prices are decreasing, it means that real money is increasing. How does that affect our interest rate? Remember the relationship. Interest rate will decrease. How does that affect your goods market model? If interest rate is decreasing, investment spending is increasing. Demand for goods and services increases. Output and income increases. So now we've explained the further decrease in price, as well as why output would return to its original level. All right. Nice thing about these chain of events is that they don't change. The variables are always the same and they're always in the same order. The only thing that changes is the direction of the arrows, exactly. And again, the arrows are all following the same pattern. So if the first one changes, it means all the rest of them change. They all move together. Okay. So you can learn it literally as one sort of chain of events. Okay, but don't do that. Rather understand why we get the movements that we do. Okay. Any questions? Now, if they ask you monetary policy, they might ask you to go one step further than this, and they ask you to explain the neutrality of money. Now, the neutrality of money, you need to learn all your nominal variables and your real variables in the ADAS graph. And you need to remember that when we use monetary policy, all the real variables return to their original. So we can see it here. Output and income return to the original. And if you go through all of these, first employment decreased, then oh, sorry, we need to put that in there as well. So when we increase output and income, employment will increase, unemployment will decrease. You can see that employment moves in the opposite direction, unemployment in the opposite direction, wages, all of them move in the opposite direction. Right. Oh, sorry, your nominal wage changes. Your real variables always return to their original values. Okay, and you've got to explain the neutrality of money. Okay. Then if they ask you for your fiscal policy change, you need to mention the effect on investment. Okay. So go through your notes. Those are all there for you. All right. Any questions on that? All right. Okay, the multiple choice. Question 1, based on the following information, which of the following statements are correct? Okay, so trade surplus, budget deficit, financial account surplus. To calculate your budget surplus or deficit, we use government expenditure and taxation. So we can see obviously there, government spending is greater than taxes, which means that there is a budget deficit of 60. To calculate your trade balance, imports and exports, we can see that exports are greater than imports. So we've got a trade surplus of 160 minus 100, 60. All right. And we've got capital inflows and outflows, which is our financial accounts. And we can see that in this case, capital inflows 130, outflows are 200, which means that there is a deficit of 70. So trade surplus of 60, budget deficit of 60, financial account surplus, no. And your answer should be A and B. All right. In our goods market model, an increase in the demand for goods implies what? Okay. In the goods market model, increase in the demand for goods implies an increase in output and income, an increase in the level of employment because you obviously need to hire more people to produce more goods and services, a decrease in the unemployment. Doesn't necessarily mean that savings would increase or decrease. Right. Question 3. In the goods market, autonomous consumption is unaffected by income. Autonomous consumption depends on wealth, expectations, and interest rates. Okay, you need to remember that. So you know that it's number 3 here, while induced consumption is influenced by income. Okay. In the goods market, an increase in the marginal propensity to consume. Now, if you had to draw that on the graph, an increase in the MPC would be a pivot of the demand curve upwards, okay, which would increase your output and income. It would cause a steeper slope of the demand for goods curve. Question 5. MPC is equal to 0.8. Which of the following policy actions will increase the level of output and income by 1,000? Increase the level of output and income. We know that it is an increase in government expenditure, so it can't be option D, or a decrease in taxation. Okay, but you have to calculate it. So to calculate it, first you need to calculate your multiplier. Gives you an answer of 5. All right. So if your government expenditure changes, how does it affect your output and income? Your output and income is equal to government expenditure times your multiplier. So if government expenditure changes by 200, the multiplier being 5, it gives us a change in output and income of 1,000. So increase in government expenditure would increase output and income by 1,000. For your taxes, remember you need to multiply it by your MPC, because if you don't earn anything or spend anything, you don't pay tax. So change in output and income is equal to taxation multiplied by the multiplier, multiplied by your MPC or small c. So tax of, I'm just going to use the correct one here, 250. You would have to obviously solve it. 250. So you could have substituted your 1,000 in for output and income and then solved it that way. Doesn't really matter how you do it. Multiplier being 5, MPC being 0.8, and you would have got an answer of 1,000. No, sorry, not the 200, 250. So it is A and C. All right, everybody all right with that? Which of the following statements are correct, referring to the balanced budget? All right, now remember your balanced budget is when government expenditure is equal to taxation. And because of this exact reason, the way we calculate the change on output and income, if the government expenditure is equal to taxation, there is an expansionary effect on output and income. So if we had to substitute 200 in for there, for our change in tax, we would have obviously got a value less than 1,000, okay? Which means that government expenditure would have been 1,000 and taxation would have been, or sorry, the change in income from the government expenditure would have been 1,000 and the change in income from the change in taxation of 200 would have been less than 1,000. Everybody follow that? So on the economy, it would be an expansionary, or it would have an expansionary effect, okay? I didn't agree with the answers here. I think it is B and C. I don't agree with A or D. I don't know if I'm reading something wrong. If you guys do go through the answers and you find anything else, please email me. I might have missed it. Right. Question 7. Which of the following statements are correct regarding the financial markets? Right. The purpose of the financial market is to give an explanation of how interest rate is determined. It is the interaction of money demand and money supply, and we get an equilibrium interest rate. Total demand for money is endogenous variable in the financial market. Okay, that is true. Your exogenous variable is your money supply. Why? Because money supply is indeterminate, or rather independent of income. Okay. So if we change income, we shift money demand. If we change income, we do not move money supply. Money supply is determined by the Reserve Bank. Okay. So it would be option A, B, and C. As the level of income increases, the transactions demand for money will do what? 3 determinants of money demand: transactions demand, precautionary demand, and speculative demand for money. Transactions and precautionary are affected by income, positive relationship. Speculative demand for money is affected by your interest rate, negative relationship. Right. So if income increases, the money demand for the transactions motive will increase. Right. Oh, sorry, hang on. Number 3. All right. Number 9, if the financial market is in a liquidity trap. So a liquidity trap in your financial markets looks something like this. So it's a situation in which the monetary authorities do not have a power over the interest rate. If they increase money supply, you can see that it doesn't change interest rates very much. Decrease money supply doesn't change interest rates very much. Okay. Generally when the interest rate is very low. Right. Not our problem, obviously. So, financial money market participants will keep money if the money supply is increased. That is true. Monetary policy is ineffective. That is true. Increases in money supply have no impact on the interest rates. So it would be option 2. Number 10. Which of the following statements are correct? Main instrument of the fiscal policy is the budget, and the main policy variables, government spending and taxation. You should know that. The result of the implementation of an expansionary fiscal policy is that the budget deficit increases. Expansionary fiscal policy, government expenditure increases and or taxation decreases. Both cause the budget deficit to increase. C. Expansionary monetary policy entails an increase in the money supply to bring about a decrease in interest rate in order to increase the demand for goods in the economy. Also correct. Contractionary monetary policy entails a decrease in the money supply, and the LM curve will shift upwards. Don't think up or down, rather think left or right. That could also be true, so it is option 1. Number 11. In the IS-LM model, now you need to remember how we derive the IS and LM curves. Okay, IS curve, goods market, LM curve, money market, and all the different variables that would affect them. All right. Investment takes place when firms increase their spending on capital goods. Investment is influenced by exogenous factors such as expectations, business confidence, and regulations. Increase in investor confidence shifts the IS curve to the right. Why? Because we would increase the investment in our goods market model. Right? Investment is negatively related to the interest rate and positively related to the level of output and income. So, on our, actually, hang on. All right, next question. So this is the derivation of the IS curve based on the following. Autonomous spending at an interest rate of 10% is 3,000. A decrease in the interest rate from 10 to 8% increases investment spending by 1,000. Remember, the first graph that we use is our investment function. Right? They're telling us that at an interest rate of 10%, we are investing 2,000. If it decreases to 8%, investment increases by 1,000. So A is 3,000. Now, autonomous spending is 3,000. Remember, autonomous spending includes investment. So they're not talking about only investments. That is your autonomous spending, which is 3,000. So variable B is 3,000. Okay. When we shift our demand for goods curve upwards, it is because of the change in investment spending in this case. So 3,000 plus the 1,000 that investment changed by would give us 4,000. Now to calculate the effect on output and income, you need to solve it. So again, output and income is equal to your multiplier times your autonomous variables. In this case, the multiplier being your MPC being 0.8 would give you a multiplier of 5. Right? Gives you an answer of 5. Substitute those values in. So value D, output and income is 5 times 3,000. And E, $20,000 and $15,000 respectively. And then obviously when we're dealing with your ISLM curve, you're deriving it, those values are exactly the same. So we get our output and income, and we get our interest rates. Right, so question 12. I'm just going to give you the answer here. You can go through it. Question 12, the answer is 2. And question 13, the answer is 3. And those obviously relate to the values that we've just calculated. Number 14, which of the following statements are correct regarding the ISLM curve? In this case, it would be A. Question 15, in the ISLM model, which of the following policy actions will bring about an increase in the level of output and income and an increase in the interest rates? All right. So your ISLM also always boils down to your monetary policy and fiscal policy. And we could see that if we wanted to increase the level of output and income and an increase in the interest rate, we have shifted the IS curve to the right, which is an expansionary fiscal policy or an increase in the budget deficit. All right. Question 16. All right, now this relates to your investment in South Africa or the rest of the world. So in this case, interest rate on South African bonds 7%, US 10%. But what's going to happen? Let's assume that you invested in the US. You sell your rands today and you buy dollars at a certain exchange rate. You invest the dollars in America, and then at the end of the investment period, you need to sell the dollars and buy rand and bring it back into South Africa. Okay? So you do not want the rand to appreciate during that time, because while your rand is invested in America in dollars, at the end of the time period, if the rand has appreciated, you're going to sell your dollars and buy less rands. Okay? So depreciation in that case would actually be worthwhile for you. All right. Now, it all depends on the percentage change. You need to calculate the difference between the two. Obviously, 10 minus 7 is 3. So it is a 3% difference between those two returns. But you need to also pay attention whether they say the rand appreciates or depreciates between that time period. Okay? So now in this case, obviously a 10% return in America, you're going to invest in America. But if the rand appreciates by 3%, you're not making anything more than if you just invested in South Africa. If it appreciates by 4%, you're losing. If it appreciates by 2% or even depreciates, you're gaining. Okay? So, it is expected that the rand-dollar exchange rate remains unchanged. You will not invest in South African bonds in that case because you are getting 10% in America, 7% in South Africa. Appreciation of the rand is 4%. You don't want that. Appreciation is 2%. You would still make more in America than in South Africa. Number 17. Comparing your contractionary and expansionary policies in the ISLM model, which of the following, okay, it's number 3. Go through all of that. You need to know these effects. They are summarized nicely in your notes for you. Expansionary fiscal or monetary policy, contractionary fiscal monetary policy, how it affects all these different variables. All right. Question 18, which of the following are correct? Right, appreciation and depreciation, these are pretty easy. I'm just going to give you the answer here. Now, when you're dealing with your goods market in an open economy, right, if they ask you to draw your goods market for an open economy in your exam, you draw these two graphs where you draw your net exports curve underneath your goods market model. Right. Goods market in a closed economy, obviously you don't do that. And if they ask you to draw the ISLM for an open economy, you need to remember to draw your interest parity relation next to it. Okay. Now, whenever you've got a shift of your net exports curve, it is due to a change in foreign demand for goods and services. So what would cause foreign demand to change? Foreign income. If foreign income increased, we would shift the net exports curve to the right. We would export more. Okay. If there is a change in local demand because of an increase in government expenditure, because of an increase in autonomous consumption, whatever it is, we do not shift the net exports curve, we move along the net exports curve. Okay. So, the question is, which of the following statements are correct? Diagram A represents a depreciation of the nominal exchange rates, while diagram C represents an increase in government expenditure. So what would a depreciation of the nominal exchange rate do? It would make our goods and services cheaper, and we would export more. Exports would increase, we would shift the demand for goods curve upwards, so that would be correct. While in diagram C, it represents an increase in government expenditure. There's the increase in government expenditure, which increases the demand and output, increasing income. And what happens when we increase income? Imports increase, exports remain the same because they are exogenous, and we move down the net exports curve into, in this case, a further deficit. Right, so option A is correct. Option B. Diagram B represents an increase in exports, which leads to an increase in the equilibrium level of output and income. That we can see. Diagram C represents the following chain of events: government expenditure increasing, demand increasing, output and income increasing, imports increasing, net exports decreasing. That would also be correct. All right, so the main things to remember there is that if it is an increase in foreign demand, you shift the net exports curve. And if it's a decrease in foreign demand, you shift the net exports curve to the left. Okay. Change in foreign demand, shift the net exports curve. Change in local demand, for whatever reason, you move along the net exports curve. Okay. Question 20. In the determination of nominal wages in our labor market model, a higher unemployment rate will decrease the nominal wage demands. Remember your bargaining power. Higher unemployment rate, lower bargaining power, lower nominal wages. 21. According to the price setting relation, now that's from our firm's point of view. Remember, price setting relation, prices equal markup over labor cost. All right. Decrease in markup of firms given the nominal wage will decrease the price per unit because they calculate the price per unit as a markup over the nominal wage. Two. 22. At point C, we can see that there is higher unemployment rate, lower real wage. Remember, wages over price, real wage. How do we calculate that? 1 over 1 plus the markup. Right. So when there is an increase in the markup, this entire term decreases and you shift the price setting curve downwards. Right. You need to remember that. So you should get an answer of number 3 for 22. 23, which of the following events is represented by the AS curve? It would be number 4. Like I said, the chain of events are standard per graph, so you can just remember them. 24, also think that this should be A and E. If you guys go through this and think of anything else that I might have missed, please email me and let me know. And finally, 25, in the ADAS model, an expansionary fiscal policy will have the following impact in the medium run. Now remember, you need to differentiate between your short run and your medium run, okay? In the short run, all right, so 25, it would be 1. All right, any questions? Okay.